Good afternoon, everyone. Just a brief moment while we wait for everyone to join. Everybody is joining, but we still got a way to go. So we'll start at 5 past just to give everyone a bit of time. So 2:05 promptly. So if you don't mind waiting, make yourselves a cup of tea, coffee, hot chocolate, I don't know, whatever takes your fancy, and we'll be back just before 5 past. Thank you. It's 2 o'clock. We'll just wait another 5 minutes um, for our colleagues to join. People are joining at the time, but it's taking a little time to join. So if you don't mind, we'll start at 2:05 and take the opportunity to get whatever you need for the afternoon session, and we'll be back with you in now 5 minutes. Welcome, everyone, and thank you for joining us on this stormy day in Johannesburg. I don't know what the rest of the country's like, but very pleased to have you with us, and pleased as usual to have Jackie presenting. And Jackie, we wait. I think we'll have a break at about 3:30. Is that all right?
Yes, that sounds good. 15 minutes break at 3:30.
Okay, perfect. So, Jackie, we waited the whole year for this year-end update, so we won't delay any more. And I'm going to hand over to you and enthrall us with this, what's going on.
Okay, good. Well, good afternoon, everyone. It's wonderful to join you again, and thank you very much for allowing me the opportunity to present to you this afternoon on the year-end tax update. As always, there's a lot to cover in our year-end update. I only have 2 lines on the outline, but of course it's all the stuff that goes behind that. As Stan mentioned, we will take a break at 3:30 for 15 minutes to allow a leg stretch, and if you need any tea or coffee or beverages at that stage. And then we'll carry through until, for another, from 4:45 until sort of 4:45, 5-ish. We'll be done by 5. So the webinar is scheduled to run from 2 until 5, and I won't be keeping you beyond that. Right, so we're going to be talking today about the 2024 tax amendments, right? And so there are quite a number of amendments that we're going to be covering. Obviously, I have sort of selected the coverage based on our audience, based on what I think might be most relevant for you, and also bearing in mind the time that we have. So we're not going to be covering absolutely every single amendment, but we'll go through what I think are the main ones that might affect the majority of you. And then we'll talk about just a few tax judgments, not too many, because actually, as Stan says, you haven't actually waited a year. It's only a few months, Stan, since I last saw you. I think I was in September, actually. And we did do a bit of an update at that stage. So we've covered tax judgments as they've happened during the year. And so there's not too much left on that side to cover at this point. All right, so we will talk a little bit about the judgments towards the end of the year. And there's some interesting judgments that have come through in the last month or two. All right, so we're going to go in and talk about the tax amendments. Now, of course, the tax amendments, as I said, there's a lot there. If you look at this list of bills, 6 bills that the Minister of Finance tabled at Parliament when he presented his medium-term budget speech at the end of October. And these bills, of course, have been through quite a long process of development, starting from before the budget speech, but it was announced in the budget speech what changes were going to take place this year. And that was, of course, announced end of February when the budget speech was presented. And then following on from there, SARS and National Treasury then went and started the process of translating that into legislation. Now, that process is quite a long and democratic process. And I must say, I think we can be quite proud of the process that we follow in South Africa and the rigor of that process. Because what happens is the draft bills are released for public comment. They are open for a month. And for public comment, anybody can comment on them. So anybody who has an interest. Now, at the time of the budget speech, the bills that were put on the table for public comment were the Rates and Monetary Amounts Bill. Not much in there because we didn't have any change to the tax tables and the rebates. So that really just had draft amendments to the Carbon Tax Bill Act, as was announced in the budget speech. And then, of course, we had the draft Global Minimum Tax Bill and the related administrative bill. And those were the ones that were put on the table at the time of the budget speech, and they were open for the month of March for public comment. In the meantime, as I say, the rest of the bills were being developed, and we then had the draft Revenue Laws Bill, Taxation Laws, and Tax Administration Laws bills. Those draft bills were then put out for public comment at the beginning of August, and they were open for public comment for the whole month of August. There were a number of submissions that were made. I think it was recorded there were something like 40-odd institutions and companies and entities that made submission, and that ranges from things like SAICA, SAIPA, SAIT, to even COSATU and of course, a lot of the beverage especially alcoholic beverage manufacturers, who are making comments around the proposed changes in the excise taxes. All right. So there were a lot of comments that were raised. Now, that process of submitting comments is really important. If you think about how many times we have amendments to correct poor wording in the legislation, and of course we also have problems with interpretation because of wording that does not properly express what the particular provision is seeking to achieve. And I will see this when we come to the Thistle Trust case a little bit later on. And the criticism that the Constitutional Court had around the wording of the relevant paragraphs in the legislation, that they were not clear. And so this process of comment is really important, not just to point out practical issues or things that are just not achievable, but also in terms of the wording. Is the wording really stating what it needs to state? And so we take all of the comments that are submitted. So as I say, all the institutions, the companies, and there were even 6 individuals who submitted comment this year. And those people are then given the opportunity to make oral presentations to the Standing Committee on Finance. So there were 2 days of workshops set up in October, where presentations were made, and certainly SAICA, SAIT, etc., and large firms like PwC and so on were all given the opportunity to make their oral presentations. And that is important, even though sometimes, and I know this from having been part of the SAICA team in the years gone by, that sometimes you feel as if your presentations are falling on deaf ears, but nonetheless, the process is important. Now, after that, a series of oral presentations, then what happens is that SARS and National Treasury, and bearing in mind that they've also interacted with stakeholders through workshops and discussion groups and so on over this period of development, they then have to put together a document where they respond to all of these comments. And that is what they call the response document, compiled by SARS and National Treasury, where they literally have to respond to every single comment that was raised on the draft bills. And that response document, SARS and National Treasury then have to present that back to the Standing Committee on Finance. And that all happened during the course of October. And then following on from that, of course, at the end of October, we had the final bills that were developed. So what comes through in the final bills is not always exactly the same as what was in the draft bill. And there's a lot of development that happens because of this comment process. And as I say, we can be proud of that comment process in South Africa, because it does result in better legislation at the end of the day. Not perfect legislation, because as we've seen, we still have amendments that have to be made subsequently to try and fix imperfect legislation, but certainly it does assist. And I think the one important development that came through this commentary process this year was that the draft amendment, and you will remember that we spoke about this in terms of the budget proposals, that there was a proposed amendment to change the VAT Act around the claiming of input tax credits. And that was an amendment to Section 16.3 of the VAT Act. So that was going to require that a vendor would have to claim the input tax in the tax period in which the vendor became, and they used the words, entitled to the input tax credit. And that, apart from the interpretative problems there, what do you mean by entitled to? Because you're not actually entitled to an input tax credit until you have a valid tax invoice and so on. All right, but what they were trying to get at is that the month in which that sort of incurral of expenditure for goods and services on which VAT was paid, that you would have to claim the input tax credit in that month. And of course, so that means if you only got your valid tax invoice some months later, you might have to go back and reopen that period and then claim your input tax credit. And of course, that would have led to huge administrative challenges for vendors. So although the amendment was put forward with the explanation that this is going to make life simpler, well, not really. It would actually make life a lot more complicated. Can you just imagine having to go back and reopen past VAT periods to claim input tax credits? So currently what you can do is you can claim that input tax credit as you go along, as long as you claim it within the 5-year prescription period, right? And that seems to work quite adequately for vendors. And SARS was saying that they needed this amendment because there were many people claiming duplicate credits. Well, I think there's different ways of doing that, right? Different ways of managing that problem. So eventually, after much discussion, they took that draft amendment off the table. So that is out of the picture now. And I think that's great. That's thanks to the comment process. If it wasn't for the people who raised comments on the draft bill, that proposed amendment would have gone through because it was announced in the budget speech, it was in the draft bill, and SARS was very keen on implementing it. But thank goodness it has been taken off the table, right? And so we won't be talking about that amendment anymore. But it's just a good example of the fact that there are changes to the draft bill that happen as a result of the comment process. SARS and National Treasury don't go and reverse their thinking. The changes between the draft bills and the final bills is entirely driven by the comment process that happens and that discussion that happens in Parliament. All right, so these bills, the final bills now tabled in Parliament. What happens from here is that, well, just a few days ago, the Standing Committee on Finance assented to these bills. So they basically gave the go-ahead to Parliament. So they will now go through the National Council of Provinces, through the National Assembly. And once they have the sign-off from Parliament, they will go through to the in-tray of the President, and they will then be signed into legislation and they will be gazetted. And that is the date of promulgation. So I mentioned that because there's quite a lot of amendments that will take place from the date of promulgation, right? And we don't know what that date is just yet because they haven't been promulgated yet. They'll be promulgated either before or after the President goes on holiday. So either before he goes or after he comes back, depending on what his workload is. All right, so it's usually around about, say, the 20th of December, otherwise in sort of the second week of January. Okay, so that'll be the likely promulgation date. So watch out for that as we go through the amendments in terms of the effective dates of the various amendments. All right, also bear in mind that when we talk about the effective dates, the general feeling and the constitutional approach is that we must not have retrospective amendments, all right? That it is unfair to have retrospective amendments. Now, sometimes it might be that you have an amendment that is actually entirely to the benefit of the taxpayers, and then one could accept that maybe a retrospective amendment is okay. But nonetheless, the general rule is that we don't have retrospective amendments. But you'll see in one or two places as we go through these amendments today that there's some that are pretty close to being retrospective, but they are useful provisions. So I don't think anybody's going to complain about those effective dates. All right, so let's go through and have a look. Let me just give you one more pointer before we start, is that I will be talking through the Revenue Laws Amendment Bill, Taxation Laws Amendment Bill, Tax Administration Laws Amendment Bill. I'm not really going to say much about the global minimum tax. That's a tax that is coming in driven by the OECD, and we'll say a little bit about it later on, but it's really affecting only your very large multinational corporations and that are part of M&E groups, multinational enterprise groups. And it's ensuring that there's a minimum tax of 15% that is paid to any constituent entities of those groups that operate in South Africa. So that's really what that tax bill is seeking to achieve. Based on the comment that was raised in Parliament, it would seem that there's not going to be that many companies in South Africa affected by this bill. They're probably around about 40, 50 companies, maybe 60. But nonetheless, for those companies that are affected, there's quite a bit of extra admin and so on that goes along with this. But it's not going to affect the majority of you, I don't think, who are in this particular webinar. We're not really going to be talking much about that. It's very much in terms of international tax and multinational corporations. All right, so we'll be talking about revenue laws, taxation laws, and tax administration laws bills, starting with the revenue laws bill. Now, the revenue laws bill is separate from the taxation laws amendment bill because this has the amendments to the two-pot retirement system. Remember that this time last year, when we spoke about the 2023 tax amendments, we had the 2023 Revenue Laws Amendment Bill, which was introducing all the amendments to the Income Tax Act to facilitate the introduction of the two-pot retirement system. This was one time when there was a little bit of a hiccup at Parliament because the implementation date was not agreed to. There was some disagreement around that, and so it delayed the final promulgation of the bill. It was pulled out of the other process, and changes were made. There was a compromise that was reached, and the Minister of Finance kind of suggested that perhaps it should be implemented 1st of September, and that was agreed to. And so they then had to change the 2023 Revenue Laws Amendment Bill, and that bill was eventually promulgated to be the Revenue Laws Amendment Act of 2024, in fact, because it was really only promulgated in June this year, although it was the legislation that was developed during the course of 2023. So it was promulgated just ahead of the implementation date from the 1st of September. And I'm sure you're all aware of all of the excitement, concern, anxiety around this implementation of the two-pot retirement system. I think most noteworthy, of course, is the savings component that became available for people to access, members of the funds to access from the 1st of September. And that arose because of the rule that said that whatever was in a person's vested component, whatever was the balance in the fund at the end of August 2024, 10% up to a maximum of 30,000 Rand per member was then transferred immediately into the savings component as seed capital. And that would enable people to access that immediately if they wish to do so. And indeed, more than 2 million Rand, 2 million people did wish to do so, because SARS processed more than 2 million applications for tax directives in the last couple of months. Many of those applications for tax directives revealed that not everybody was fully tax compliant, and SARS had quite a bonanza in terms of paying off outstanding tax debt and so on out of the money that was coming from the retirement system. Nonetheless, it would seem that in total, the gross amount that was paid out so far has been in the region of 35 billion Rand out of the retirement system into the hands of the members. And who knows now, who knows where that money's gone. I mean, I sort of hear various possibilities, even today, listening to the financial report, and they were saying companies like Foschini and so on have been showing good results, maybe because of the money coming from the two-pot retirement system. So maybe that's where it's gone. Some of it seems on gambling, and who knows where that money is. Hopefully, a lot of the money was used to pay back debt. Certainly, a large chunk of that 35 billion, probably to the tune of about 7 billion Rand, went to SARS. All right. And that's not just to pay off outstanding tax debt. That was also because, of course, whatever came out of the retirement system from members' savings components becomes fully taxable. It comes into the person's gross income. Okay, so there's a new paragraph in the gross income definition, a special inclusion paragraph ED, small e, capital D, that specifically includes in a person's gross income any savings withdrawal benefit. All right, so you take the money out of your savings component, that is part of your gross income, it's fully taxable. And that's why anybody who wanted to take money out of the retirement system had to apply for a tax directive. All right, so that was all happening on the 1st of September. And of course, just to remember that going forward, people's contributions from the 1st of September onwards, 1/3 allocated to the savings component, 2/3 to the retirement component. All right, so it's really, as I've always said, should have been called the three-pot retirement system, because you've got the vested component, whatever was there at the end of August. You can't add to that now. That remains as it was, except that, of course, the fund keeps managing that money and it'll have investment returns, and so it'll grow by those investment returns. But then going forward, the contributions going 1/3 to the savings, 2/3 to the retirement component. The savings component is available to be accessed. People can take their money from the savings component at any stage, except there is the limitation that you can only make one withdrawal per year. All right, and that takes into account the withdrawals that people made on the 1st of September or soon thereafter. And the other requirement is that you cannot take out less than 2,000 Rand. So it's got to be minimum 2,000, because, of course, the administrative process that the funds have to follow, applying for a tax directive, and first of all, of course, informing the member answering the call center, telling them what this is all about. You know, it costs money to process these applications. And in fact, the funds have been charging, and I see that there's been some concern about maybe how much the funds have been charging to process these applications, anywhere from 350 to 600 Rand per application. And so out of that 35 billion coming out of the retirement system, I've mentioned about the money going to SARS, but there's about R1 billion, it seems, that the retirement funds will make in terms of fees. Well, maybe, you know, it's not all bad, because they're going to be losing out on their interest on the money that's now disappeared out of the retirement system and gone into other channels. All right. Now, just remember also that the retirement component cannot be accessed until retirement. So even if a person leaves their employment during their working life, they would have to transfer that retirement component to another retirement fund or a preservation fund, but you can't take the money out even if you change jobs. All right. So that retirement component is 100% protected until the person gets to retirement age. And then 100% of the retirement component has to be taken by way of an annuity. There's no 1/3 lump sum, 2/3 annuity or anything like that, all right? But that 1/3 lump sum, 2/3 annuity rule still applies to your vested component, okay? So this starts getting really complex, having all these different regimes and thinking about when each set of rules changed. But the point is that whatever was in your retirement fund at the end of August is subject to the protection of vested rights. And so whatever rules applied at that point will continue to apply to that money. But the new contributions going in go to the savings and retirement components. All right. So in terms of all of this, there were some amendments to the definitions that were needed to clarify the definitions, and then also amendments to clarify skills development levy and UIF, which I'll come to just now. So the definition, so there was the definitions of members' interest in the retirement component, savings component, vested component, all right? Now, these all are in the Income Tax Act, and obviously these definitions are critically important to the whole implementation of the retirement system. Remember that the rules of each fund have to align with these definitions in the Income Tax Act in order for that fund to be approved and to be registered as such. So when we talk about the members' interest in each of these components, these definitions have each been amended to clarify that when there's amounts taken out of a person's retirement savings under Pension Funds Act Section 37D. Now, this is the one time when your retirement funds are maybe not absolutely protected. You know, normally you could say your retirement savings are protected from creditors and so on, but there is the provision in the Pension Funds Act, specifically Section 37D, where money can be taken from a member's fund and paid to somebody else. And that's in terms of 37D1, and it's all these different paragraphs, and that's why I've listed them all here. So you've got your A, B, and C, your loans, guarantees, compensation, recoverable, your premiums, etc., to a medical fund or long-term insurer, divorce orders, maintenance awards, interim maintenance awards, and employees' tax on your maintenance awards. Now, just to clarify, so they did originally have this provision in the definition that said if money is taken out of a member's benefit or minimum individual reserve in terms of Section 37D1, and they listed the first four, then what would happen is the point here is that amount that is taken out of the fund is allocated pro rata across the different components. All right. So if at the time that withdrawal is made, the person has 40% vested component, let's say 30% retirement component, and the balance in the savings component, then this amount is taken out of the person's minimum individual reserve. You would allocate that pro rata across those different components. All right. So they would all take their own reduction, as it were, in the balance of that component. Okay, so you can't choose to take it out of one or the other. It has to be pro rata against those three. Now, they just missed out the interim maintenance awards initially, and they've now catered for that as well. And now what they've also, I've put these little asterisks here to indicate that these amounts are included in income under Section 11. And so there's also amendments to Section 11 because in both cases they overlooked the interim maintenance award, so they've made the necessary changes. Okay, so it's not a huge change, but I just wanted to clarify how this actually works when there is an amount taken out of a member's minimum individual reserve, so that it has to be allocated pro rata across the 3 components. All right. Then the other one clarifies the savings withdrawals. Now, remember that I said that whatever amount is in a person's savings component is available to be withdrawn at any stage, subject to the criteria that you can't take out more than once per year and you can't take out less than 2,000 Rand. But there is a slightly separate set of rules if a person is exiting a fund. So they've amended the definition of savings withdrawal benefit to clarify that if a person exits a fund, they can withdraw the total balance in the savings component, even if they have already made a withdrawal from the fund during that year, if the balance is less than 2,000 Rand, okay? Because then there's just no point transferring that across. The amount is just too small. So whether you've made a withdrawal already or not, if your balance is less than 2,000 Rand, you can clear it out when you exit a fund. All right, and that's not going to undermine the whole maintenance of retirement savings that is which is the objective of the 2-pot retirement system. Then we get to the skills development levy and UIF. Now, this is quite an interesting one. I mentioned earlier that any withdrawal from a person's savings component comes into their gross income under paragraph ED of the gross income definition, a new paragraph that's been added into the gross income definition. Now, that also features in the definition of remuneration. All right, so any amount paid out of a person's savings component becomes gross income, is also remuneration as defined. And of course, the fund then has the obligation, it stands in as the employer in that context and has to withhold the correct amount of employees' tax. And that will be done according to the SARS directive. But then the question arises, well, if it's remuneration, then what about skills development levy and UIF? And now they've realized another oversight. And as you can see, so even with the whole process, there's still imperfections that come through the legislation. They've now realized that, yeah, they should have made these clear that there's an exemption from the SDL and there's an exemption from the UIF. So any payouts from the savings withdrawal benefit, savings component, will not be subject to SDL and UIF. And that'll obviously be effective from the date that the 2-pot system came on stream, from the 1st of September 2024. So I've just made a typographical change. Section 34C is the correct section number. I think on the slides that I sent out previously, it said section 35. Okay, so if any of you are going to go and check that, you'll find it in the Skills Development Levy Act, section 34C. That's where there's the exclusions or exemptions from SDL, and this particular one applies to your withdrawals from your savings component. Okay, so just to clarify that one. Right, so those are all the amendments around the 2-pot retirement system, and so that system is now running. And so even though we've had this initial 35 billion Rand already paid out from the retirement funds, that's not the end of the story, because of course there's still, this is ongoing now, is that people can withdraw from their savings component. So it's going to be interesting to see as we go on what happens between now and the end of the year, in terms of how much money is actually taken out. And of course, what is particularly interesting is to see how much money SARS makes out of this. Now, in the budget speech earlier this year, they did put the estimate on the table that they would probably get about 5 billion Rand out of these withdrawals from the 2-pot system. And it looks like they've already surpassed that. And we still have a few months to go until the end of the government's financial year. So I think it's going to be quite a bonanza as far as SARS is concerned. Anyway, let's go on and have a look now at the main tax amendments in the Taxation Laws Amendment Bill, right? So the Taxation Laws Amendment Bill is always the bill that has the kind of the most amendments, because these are all the sort of main technical amendments that come through this particular bill. And I've listed just a few of them here. the main ones that we'll be talking about today. There are some others, all right? As I mentioned earlier, I'm not going to talk about absolutely every amendment, but these are some of the main ones. And you can see that there's amendments to the Employment Tax Incentive Act, and then there's a whole lot of amendments to the Income Tax Act, and then lastly, there's an amendment to the VAT Act, all right? So across those three different acts. So let's have a look at the amendment to the Employment Tax Incentive Act. And this is a new provision that's been added into the Employment Tax Incentive Act, introducing a penalty, a 100% penalty, if an employer receives the ETI in respect of an amount that must be disregarded in terms of the proviso to the definition of monthly remuneration in Section 1.1 of the ETI. Now, this relates to, you will remember a few years ago, SARS and National Treasury were highlighting that a number of schemes had been developed to try and optimize the utilization of the ETI. One of the schemes in particular that they were targeting was where employers would sign up employees and pay them remuneration, but then the employee did not actually work for the employer. The employee was actually studying, and the remuneration was then used to settle the study fees. Now, it's not to say that that is a bad idea, because, yeah, it's great. It's a noble pursuit, because anything building skills is also really important in South Africa. But one has to remember that the policy intent behind the employment tax incentive was to incentivize employment. It was to incentivize work experience. And so the whole idea of the ETI was to say to employers, if you will give young, inexperienced people the opportunity to work and pay them a wage or a salary, we will subsidize that through the ETI. So that was the intention of the ETI. It wasn't to pay study fees. There's other things that are done by government to address study fees and bursaries and things like that, right? But the ETI is there, and the sole objective is to give people work experience. And so they did amend a couple of years ago the definition of monthly remuneration for the purposes of the ETI to exclude remuneration paid to an employee who's not working mainly. They're not spending most of their time working for the employer. So if they're spending most of their time studying, then that will not be remuneration that qualifies for the ETI. So that should be a remuneration that is disregarded when you calculate the ETI. So if an employer persists in calculating the ETI on this remuneration that is supposed to be disregarded, for every month that you claim the ETI inappropriately in that way, this penalty will apply at a rate of 100%. Okay, so whatever ETI you're claiming, you're going to have to pay that back, and you're going to have to pay the 100% penalty. And it doesn't end there, because during the comment process, the points were raised that, well, what about the penalty that we already have in the Tax Administration Act, the understatement penalty? And that was amended last year to incorporate overclaiming. The ETI was classified in the definition of a shortfall, a tax shortfall that results in the understatement penalty. And SARS and National Treasury replied that this penalty in the ETI Act will apply separately and in addition to any penalties in the TAA. So this could be extremely onerous if a person is calculating the ETI on remuneration that should be excluded. So please be very careful about this, and of course warn your clients to make 100% sure that they are claiming ETI correctly, all right? Because if not, you could end up with your understatement penalty and this penalty under the ETI Act. It seems like quite a heavy measure, but be that as it may, they have implemented this. So this additional penalty will come into effect for years of assessment commencing on or after 1 March 2025. All right, but I would strongly, very strongly recommend that people look very carefully at the ETI and make sure that they are calculating it on the correct remuneration. Alrighty, and then the other definition that is being amended in the Taxation Laws Amendment Act is this definition of connected person in Section 1. Now, this definition of connected person in Section 1 is probably the most wide-reaching aspect of our anti-avoidance legislation in the Income Tax Act, all right? Because, I mean, if you look at a number of provisions which have an anti-avoidance aspect, it will be where there are connected persons as defined in section 1. For example, if you sell an asset to a connected person, paragraph 38 of the 8th schedule provides that the proceeds are deemed to be the market value of the asset. All right. And if you make a loss on the disposal of an asset to a connected person, you cannot set that capital loss off against other capital gains. And so it goes on. Even later on, we're going to talk about transfer pricing, and transfer pricing applies where there are connected persons. When we have section 7C with a deemed donation that we're going to talk about later on, that applies where your individual and your trust are connected persons. So this definition of connected persons is an extremely important definition. But having said that, remember that the definition is broken down. So you have paragraph A of the definition talks about who is a connected person in relation to a natural person, okay? So it's all your relatives are your connected persons to a natural person. Who is a connected person in relation to a trust? That's dealt with in paragraph B. And then paragraph C, which is what we're looking at here, looks at who is a connected person in relation to a partnership. Then paragraph D talks about who is a connected person in relation to a company. So this one here, paragraph C, that talks about who is a connected person in relation to a partnership, or it refers to foreign partnership. And it says each member of the partnership is a connected person in relation to any other member, and any connected person in relation to any member of the partnership or foreign partnership. So you can just imagine if you had a partnership of 100 people, you know, that scope of connected person is going to be extremely broad. Every partner is a connected person to every other partner, and whoever is a connected person to you is a connected person to your partners. Now, that in itself is quite an onerous provision, because bear in mind, if you have any of these transactions with a connected person, then you've got to apply the respective tax provision. Now, that's all well and fine, but what happens if you have a partnership, an on-commandite partnership, where perhaps you don't know the identity of all of your partners? Now, section 24H, which is our provision in the Income Tax Act that deals with partnerships and how we tax partners in a partnership, that considers this aspect of a limited partner. And that means, it's a defined term, right? It means any member of a partnership on commandite, an anonymous partnership, or any similar partnership or foreign partnership. So it recognizes that there could be a partnership where there is a secret partner or an anonymous partner, okay? And that's usually going to be an investor who invests money, but they're not involved in the day-to-day activities of the partnership. And so they've now realized that this definition of partnership, of connected person in relation to a partnership, assumes that everybody knows who all the other partners are. And it doesn't cater for the situation where there might be an on-commandite partnership. There could be a limited partner, and not everybody necessarily knows who the other partners are in the partnership. So the reason for the change is to recognize this aspect of limited partners in an on-commandite partnership. But I think this has especially come to light in recent years with these tax incentives like Section 12B, 12BA around assets used for sustainable energy production. And there have been a lot of investment opportunities put forward for people to invest in to access those tax allowances. And you would have to be a partner in a partnership to access the allowances, because obviously if you're a shareholder in a company, it's not going to give you that access. But when you go into one of those kind of investment partnerships, that's typically going to be an on-commandite partnership, right? You don't necessarily know who all the other partners are. So they're now making a proposal to this definition. So the definition will continue to read as stated here, but it will then have this bit that says, excluding a member who is a qualifying investor in such partnership. And qualifying investor, interesting, they're using that term because that is already a term that is defined in Section 1, and it basically applies to your limited interest partners in a partnership. So a qualifying investor will be somebody who has invested into a partnership. Their identity is not known necessarily to the other partners. They are not involved in the day-to-day activities of the partnership, and they don't have the ability to contract that partnership with somebody else. All right, so that's the idea of this qualifying investor. So if there's a qualifying investor in a partnership, they're not regarded as being connected persons to any other partner in that partnership. But insofar as any of the partners are known to anybody else, well, then, if you know who your partners are, then they're connected persons to you. That's basically what this is saying. Now, this amendment will be for years of assessment commencing on or after 1 January 2025. So quite an interesting amendment coming through there. And I think it's way, way overdue. I mean, we've had this definition of connected person for how long? And now it's come to light that actually we need to have this amendment. So I think here maybe they could have done it retrospectively, but they have done this prospectively for years of assessment commencing on or after 1 January 2025. Okay, and then another definition that's receiving attention is this definition of retirement annuity fund. Now, this is an amendment, again, that has been brought about as a result of the two-pot retirement system, although it's an amendment in the Taxation Laws Amendment Bill, not in the Revenue Laws Amendment Bill. And this talks to paragraph B10cc of the proviso to the definition of retirement annuity fund. Now, if you think about the nature of a retirement annuity fund and the rules around a retirement annuity fund, the idea is that you pay your contributions into the retirement annuity fund, and you would not be able to access that until you get to retirement. Okay, so unlike a pension or a provident fund, which enabled prior to the two-pot system, right? But on your prior to the 1st of September and for the vested benefits, you could have accessed, you could have taken a withdrawal benefit if you left the employment linked to that fund, etc. But with the retirement annuity fund, there's no option for withdrawal benefits unless you actually emigrate and you cease to be a resident. That's a different story. But otherwise, you have to leave that money in the fund until you get to retirement, except that this proviso does allow that if a person discontinues their contributions prior to retirement and the interest is below an amount specified in the Gazette, and that is currently sitting at 15,000 Rand. So if their balance in the fund is less than 15,000, they've stopped their contributions to the fund, that's the one time they could take the money out of the fund before they get to retirement age. Now, I mean, it's a fairly small point, but it's an interesting point, is that one of the commentators noted here that when we talk about the member's interest, if we say the member's interest is below 15,000 Rand, now in terms of the two-pot retirement system, we no longer really just talk about members' interest. Remember, we looked at these definitions just now, and we talk about, let me just show you what I mean here with these amendments, the definition. We talk about members' interest in the retirement component, savings component, vested component, all right? So we don't just say members' interest. So now in terms of this definition of retirement annuity fund, we need to be more clear than just say the members' interest. Now, in the commentary process, SARS and National Treasury indicated they would then change the wording to say the members' interest. They would refer specifically to savings, retirement, and vested components. But then the amendment that came through basically reads, instead of just saying the member's interest, it says here, if the member's interest in the vested component together with the member's interest in the retirement component is less than an amount specified, which is that 15,000 Rand. So it doesn't specifically refer to the savings component, all right? So it's talking about the vested component plus the retirement component does not exceed 15,000 Rand. And that's because whatever was in your savings component would be available for withdrawal anyway. Okay, that's always available for withdrawal, except, of course, the once per year, 2,000 Rand de minimis, etc. But you don't have to have a special rule for that. But here we're talking about the vested and retirement. But it then raises quite an interesting point that if a person has been contributing to an RA and they have something in the savings component and a vested component and a retirement component, technically they could be taking out more than 15,000 Rand under this rule. Because let's say your vested and retirement component together comes to 14,000 and maybe there's another 3,000 Rand in the savings component, technically the person can take the whole lot out, 17,000. 3,000 under the rules relating to a savings component, and the 14,000 under this rule, which talks about the vested component plus retirement component is less than 15,000 Rand. Okay, so yeah, I've said they're unclear why it doesn't refer to the savings component. I should take that out now because it has now become clear to me that it doesn't refer to the savings because you would be able to withdraw from the savings component in any event. Okay, so that's the amendment over there. I think I did see a question coming in. Let's see if I can see the question. Okay. If a proposal is effective for years ending on or after 1 Jan, does this mean years ending Feb 25? Okay, so you've got to be very careful when we talk about the effective date, all right? If it says the amendment is effective for years ending on or after 1 Jan 25, then that could affect your Feb 25 year. Most of the time, it says it's effective for years commencing on or after, which means that if you have a February year end, it'll be for the year commencing 1 March 25, ending Feb 26. All right, so you need to look very carefully at what the specific amendment actually says and what the effective date is in that particular amendment. All right, so let me just, if I go back here, years of assessment commencing on or after 1 Jan. So that'll affect you for the first time. If you've got a February year end, it will affect you for the year commencing 1 March 25, ending Feb 26. Okay, so you have to look very carefully at the wording. Okay, then another amendment that's come through here, also linking to retirement, all right? But, and again, sort of looking to some extent around the two-pot system, but this is another amendment that has been done. It's not specifically linked to the two-pot system. This is an amendment to paragraph 6A of the second schedule. Now, paragraph 6A of the second schedule, if you think the second schedule deals with retirement benefits, payouts from retirement funds, okay? And this particular paragraph, 6A, talks about lump sums that are taken or transferred tax-free after a person has reached retirement date, but they haven't yet taken their money out of the fund. All right, so you might have the retirement date in the fund might be 55, which is often the case, all right? Now, the person might get to 55 and they don't want to stop working. They don't want to take their money out of the fund. The preferred, more sort of conservative savings route, of course, is to keep your money in the fund for as long as possible. Maybe they get to 60, 65. They don't want to take their money out of the fund, but they are past the official retirement age, but they haven't retired from the fund. So paragraph 6A then allows certain transfers to be made between funds when you are in that category of having gone past retirement age, but you haven't taken your money out of the fund. For example, it talks in paragraph 6A, A, B, etc. It talks about from a pension fund to a preservation fund or a retirement annuity fund, from a provident fund to a preservation fund or a retirement annuity fund. Paragraph 21C basically allows tax-free transfers after retirement age, and paragraph D was amended to allow tax-free transfers after normal retirement date, but before actual retirement, from a pension or provident to another pension or provident fund, if it is an involuntary transfer. You see, the earlier paragraphs I was talking about from pension to preservation or RA, from provident to preservation or RA, but if you want to go between pension fund, provident fund, or vice versa, then basically that can only be allowed to be a tax-free transfer if it's subject to an involuntary transfer. So that would be, and this was a 23 amendment, but I just want to put it on the table here. That would be if you, for example, were working for company X belonging to pension fund X, company X now gets taken over by company Y, and all of the members have to transfer to the pension fund of company Y. So that would be an involuntary transfer, and that would be allowed to be done tax-free if you fall into that category. Now, they've also added in another category which allows tax-free transfers between retirement annuity funds, and I think that's quite an important one. Initially, they also wanted to say if it's an involuntary transfer, but it was pointed out in the commentary process that with retirement annuity funds, you can't really say involuntary only, because retirement annuity funds are not linked necessarily to an employer. Usually they're not linked to an employer. So there's no thing about involuntary or voluntary. It's pretty much all voluntary. And so they will allow this as a tax-free transfer, even if it's a voluntary transfer between one retirement fund to another, if you have already reached retirement age. So that's what that transfer is over there. Let me just see. I see another question coming in. Okay, great. Right. Okay, so let's go on to the next amendment. Quite an interesting one here on the 6-quart rebate. Now, of course, the 6-quart rebate is our means in South Africa of giving relief for double taxation. And it's only available to residents. So it applies where you have a resident who is taxed in South Africa and in another jurisdiction on the same taxable income effectively. And then we will give a 6-quart rebate. So we give a credit in South Africa for the foreign tax that has been paid. But of course, it is subject to a lot of conditions and limitations. For example, if you've paid foreign tax on a dividend that is totally exempt from tax in South Africa, you're not going to get the 6-quart rebate on that because the foreign dividend doesn't actually have taxable income. So this talks about amounts that are included in a resident's taxable income on which foreign tax has been paid. And Proviso 2 currently refers to foreign dividends, but now we're talking about foreign dividends that are not 100% exempt, all right? They're partially exempt, where we use the 25/45 calculation to work out the exemption if we're dealing with a resident individual. Now, that Proviso 2 currently says that when you look at the foreign tax paid on that foreign dividend, we look at the whole amount of the foreign tax as if the whole dividend was taxable. Later on, we do have to go through limitation rules, but initially you treat it as if the whole foreign dividend is taxable. And now they're going to extend this to also apply to capital gains. So you see, currently, a resident taxpayer, let's have a look at this from the explanatory memorandum, a resident taxpayer who disposes of a capital asset in a foreign jurisdiction, resulting in a capital gain subject to tax in that jurisdiction, cannot utilize the full tax paid in the foreign jurisdiction against our South African tax on the capital gain. And that does result to a certain extent in double taxation. We can get the rebate, but there is a limitation that happens at the moment. And that limitation works like this. It basically says that if you've got a capital gain in South Africa, you're only going to be taxed on either 40% or 80% of that capital gain, right? 40% if you're an individual, 80% if you're a company or a trust. You don't get taxed on the whole capital gain. Now, if you've been taxed on that capital gain in the other jurisdiction, before you work out your 6-quart rebate, we have to apportion currently that foreign tax on that same basis of 40% or 80%, depending on what type of person you are and how much of your capital gain is taxed in South Africa. But now this amendment will allow the full tax on the foreign capital gain to be considered for the 6-quart rebate, similar to what we see with the foreign dividends. Okay, so now here again, if we look at this effective date, for years of assessment commencing on or after 1 Jan 25. So if you've got a February year end, it'll affect you for the first time for the year ended February 2026. Let's just have a look at an example to just illustrate what the benefit is of this amendment. It's not always going to translate into an absolute benefit. It depends on the person, how much tax they've paid in South Africa, how much tax they've paid overseas, and so on. But just to take a very simple example, let's say you've got resident company X that disposes of an asset in a foreign country, proceeds of 1 million, base cost 200,000. So you've got a capital gain of 800,000, right? Now, in terms of the South African tax law, we include 80% of the capital gain in taxable income under Section 26 Cap A. So our taxable capital gain is then 640,000, and we would pay tax on that at 27%. 172,800 is our South African tax on that capital gain. But now let's assume that that gain was taxed in the other jurisdiction as well. And let's assume the whole capital gain was taxed at 20%. So we paid foreign tax of 160,000. Now, you can't just say, all right, I'm going to claim a 6-quart rebate of 160,000. Currently, the first thing you have to do is you have to apportion that foreign tax of 160,000 according to how much of your gain is taxable. So out of our capital gain of 800,000, 80% was taxable. So our taxable capital gain in relation to our total capital gain, 80%. So you'd have to apportion that foreign tax on the basis of 80%, which gives you 128,000. So you immediately lose the benefit of the 6-quart rebate on this 32,000 Rand. All right. And so this amendment is overcoming that. You don't have to do this initial apportionment. You would use the whole amount of the foreign tax of 160,000, but you still have to go through the other calculations to work out your final 6-quart rebate. And if you want to see the complexity around that, have a look at interpretation note number 18 from SARS. I think that's currently running at over 100 pages, and it's got all sorts of calculations around the limitations that one has to do and the calculations you have to do in order to work out your actual 6-quart rebate at the end of the day. But at least it does start from a broader perspective. It starts with a bigger number, all right? So you don't immediately forfeit the 32,000 Rand as we did before. But notice again this effective date, all right? Years of assessment commencing on or after 1 Jan 2025. Okay, so that's that amendment. There's also another amendment to section 6 quat, and this links to the translation rule. Now, 6 quat 4 has a translation rule because obviously if you're a resident, you want to claim your rebate for foreign taxes paid, you've paid those foreign taxes in a foreign jurisdiction using foreign currency, right? So you paid US dollars, euros, whatever the case might be. How do you translate that now to rands? Well, in terms of the general translation rule in 6 quat 4, you would use the average exchange rate for the year of assessment of the resident, okay? And you pick up those average exchange rates from the SARS website. So it says for the year of assessment of the resident. But now there's a bit of a disconnect because what happens when we are dealing with a controlled foreign currency? And so now we veer into the realm of section 9 cap D, controlled foreign currencies. Now, controlled foreign companies. So the rule is that if you're a South African resident that holds shares in a controlled foreign company, if section 9D applies to you, which it will, failing any exemption that you might be eligible for, but let's assume section 9D applies to you as the resident, you have to include the net income of that CFC in your taxable income. So what you then have to do is you have to have a look at the CFC. For the CFC's year of assessment, the foreign tax year, you would have to work out what would the taxable income be of that CFC using South African tax rules and pretending that that CFC is a resident, all right? So if that CFC was a resident, what would its taxable income be? And you go through that whole calculation. And then, right, what percentage do I hold in that CFC? If I hold 100%, then I must bring 100% of that taxable income into my taxable income. That's the imputation rule under section 9D. All right, now how do I translate that foreign taxable income? I have to translate that using the average exchange rate for the foreign tax year. That's the translation rule we use for section 9D. But now when I bring in that taxable income into my taxable income, I'm then allowed to get a 6 quat rebate for the foreign taxes that the CFC has paid on that taxable income. So even though I didn't pay that foreign tax, but it's creating this look-through rule that I'm including that taxable income, so I'm now allowed to claim my share of the foreign taxes that the CFC has paid. But now when I look at the translation rule, 6 quat 4 tells me I must translate those foreign taxes using the average exchange rate for the residence year of assessment. So there's a disconnect. 9D uses the average exchange rate for the foreign tax year. 6 quat uses the average exchange rate for the residence tax year. And those tax years might not be the same. And if they're not the same, you're going to end up with two different exchange rates. And so they've now realized that this is a problem. And so they are making a change in terms of the translation rule. So for CFCs, 6 quat will be adapted to provide that you will use the average exchange rate for the foreign tax year like you do for 9D. All right. So for everybody else, we translate foreign taxes using the average exchange rate for the residence year of assessment. That for CFCs, we use the average exchange rate for the CFC's foreign tax year. All right. And that's for both 6 quat purposes and 9D purposes, so that we're using the same exchange rate there. All right. So quite interesting it's taken them this long to realize that we actually need that amendment. Then we get on to an amendment to Section 7C, still in the area of international tax, where we're talking about a cross-border loan. But perhaps let's just start with a simple example just to remind ourselves of how Section 7C actually works. Now, Section 7C applies when we have a loan that has been advanced by an individual or a company at the instance of an individual, and that's a loan to a trust or a company that is owned by a trust, where the individual and the trust are connected persons. There's that issue around connected persons again. So if we just took a very simple example, if we have an individual who advances a loan to a trust, and if his children are the beneficiaries of that trust, then the children are connected persons to the trust, and the children are connected persons to him because they are his relatives, and that makes him a connected person to the trust. So then Section 7C will apply. And then what happens is that we say, right, for that loan, what interest rate is being charged? Now, if there's no interest on that loan, if it's an interest-free loan, and SARS official interest rate is, let's say, 8%, then we would have to say, what would the interest be on that loan if we use the SARS official interest rate of 8%, minus what interest rate are you actually charging? 0. And so the difference is your interest benefit, and that amount of interest each year becomes a deemed donation, right, under Section 7C. It's a donation deemed to be made by the individual behind the loan. And the amount of the deemed donation is that interest differential, the interest benefit on the loan. The difference between what would the interest be using SARS official rate of interest versus what interest rate are you actually charging. Okay, now Section 7C, we understand it creates this deemed donation, but there are a number of exemptions under Section 7C5. And one particular exemption looks at a cross-border loan that is subject to the transfer pricing provisions in Section 31. So it exempts a loan, advance, or credit that constitutes an affected transaction as defined in Section 31(1) that is subject to the provisions of that section. Now, if we take my example, I started individual advancing a loan to a family trust. So what we're talking about here is where that trust is an offshore trust, okay? They're still connected persons, but the trust is an offshore trust. And so we have a cross-border loan between connected persons. It's an interest-free loan, and that means it contains terms and conditions that you would not normally see in an arm's length transaction. That makes it an affected transaction under Section 31(1). And then what makes it subject to the provisions of that section? Well, that means there is a tax benefit that has resulted in transfer pricing adjustments having to be made under Section 31. So currently this exemption applies if you have a loan that is subject to the transfer pricing adjustments under Section 31. All right. Now, the transfer pricing adjustments, quite interestingly, there you're going to be looking at your adjustments, looking at the actual arm's length rate on that loan. So for Section 7C, your basis of measurement is what is the SARS official rate of interest. But for Section 31, your benchmark is what is the arm's length interest rate on that loan, and also talk about the quantum of the loan and so on, all right? But let's just think about the difference in interest rates for the moment. Now, if the SARS interest rate is 8% and the arm's length interest rate is 5%, then you're going to be making transfer pricing adjustments around the 5%, but Section 7C would be looking at 8%. And so we're giving a full exemption, but you're only making adjustments up to the 5%, not up to the 8% that you would use for Section 7C. So although this exemption was seeking to avoid double tax, now they realize, hold on a minute, there is actually a bit of a gap here, an amount that ceases to be taxed, which could otherwise be taxed, all right? And that's where your arm's length interest rate for Section 31 falls below the SARS official interest rate for purposes of Section 7C. And so the reason given in the explanatory memorandum is that the transfer pricing adjustment may not be the full interest benefit as considered in Section 7C, because Section 31 looks at the arm's length interest rate and 7C looks at the official rate of interest, SARS official rate of interest. And the difference is going to be where, they worried about where the arm's length interest rate is less than the 7C rate, which might often be the case because South Africa is regarded as being in quite a high interest rate country compared to many of our trading partners. If you think about the US, Europe, and so on, many of those have interest rates lower than what we have. All right, and this is really what they are concerned about. So the amendment here is going to say that the exemption will apply only to the extent of an adjustment being made in Section 31(2). And I'll show you an example to illustrate this in a moment. But just note here the effective date again, years of assessment commencing on or after 1 January 2025. Okay, now let's just have a look at how the difference that this is going to make. So currently, as I've said, if you have a Section 31 adjustment, then that loan is excluded from the application of Section 7C. So if you have this situation, let's say you've got X, a resident natural person, advances a 10 million Rand loan to a non-resident trust that is a connected person, no interest is charged, and so that's a non-arm's length feature of that loan. That makes it an effective transaction, all right, in terms of Section 31. And if there is a tax benefit, which in this case there would be, because X is lending this money and is not earning interest on this loan. So if he was earning interest in a normal arm's length situation, he would be earning interest and he would be paying tax on that interest. Okay, now he's not paying tax because he's not charging interest. So that's where the tax benefit comes in. As a result of that, we have to now apply Section 31 in terms of the transfer pricing provision. So we have to say, what would the interest be if that trust borrowed the funds from a financial institution? So wherever that trust might be based, Guernsey, Jersey, whatever, if they went and borrowed the funds from a financial institution, what interest would they have paid? And of course, it also links to how much could they have borrowed? Okay, because you also got that aspect is the quantum of the loan. But let's just keep it simple and say we're still talking about a 10 million Rand loan at 5%. So the arm's length interest would be 500,000 Rand per annum. Okay, so the Section 31 adjustment will be based on that 500,000 Rand. Now, if we were looking at Section 7C, we'd be using the SARS official interest rate, and that might be 9%. It was last month or even this month before the change in the repo rate, 9% per annum, okay? So you can see there's a difference between those two interest rates. Now, in terms of Section 31, X, the lender, would have to make a primary adjustment. They'd have to add on to their taxable income this primary adjustment of 500,000 Rand, okay, being the arm's length interest differential. And they would have a secondary adjustment, which is a deemed donation. So there's two adjustments always with transfer pricing, the primary adjustment and the secondary adjustment. But important to note here, the primary adjustment is done through Section 31(2), and the secondary adjustment happens through Section 31(3). Now, if you have a look over at this exemption, it applies to the extent of an adjustment being made under Section 31(2). which is the primary adjustment, okay? So basically, currently, we would say we're not going to apply Section 7C at all because we are making transfer pricing adjustments. But once this amendment comes into play, we will say that the exemption is only going to apply to the extent that we have made the transfer pricing primary adjustment under section 31(2). So we'd have to say under section 7C, we'd have to do an adjustment based on the 9% interest rate, okay, minus the exclusion, which is the amount that is the primary adjustment, 500,000. So you would still have a 400,000 deemed donation that would have to be taken into account, and there'll be donations tax payable on that deemed donation at either 20 or 25%, depending on the person's lifetime donations up to that point. Okay, so this does have a significant financial implication for people who have loans to offshore trusts that are family trusts and they are connected persons. And it's something that you really do need to pay close attention to. All right, so currently you would get an exemption of the whole lot, but once this amendment becomes effective, your exemption will be capped at the amount that is adjusted for under section 31(2), that primary adjustment, and the balance then would still give rise to a deemed donation. And this is for years of assessment commencing on or after 1 January 2025. Okay, so an important amendment to take notice of there. Let me just see if there's another question. How do you determine the arm's length rate? It's a good question. And well, that is a question that it's like, how long is a piece of string? It's a very, very difficult question to answer in many cases. With the arm's length interest rate, as I say, the question is, what interest rate would you pay if, in this case, the trust had to go and borrow that money from the local bank? Of course, with transfer pricing generally, you know, depending on what kind of transaction you're talking about, if sale of intellectual property, trading stock, interest rates, etc., sometimes it can be extremely difficult to determine an actual arm's length rate. But the short answer is that in this particular instance, you would have to say this trust is based in jurisdiction X. If it borrowed the money in that jurisdiction, what interest rate would it be paying in that case? All right, but it is quite a complex situation to actually work out what is the real arm's length interest rate that would be paid. There are banks and banks of specialists who they spend their whole life just working out arm's length prices for transfer pricing purposes. So yeah, it can be quite a complex one to answer. All right, then let's go on to this next amendment. And this is an amendment to the section 11NA of the Income Tax Act, which allows a deduction for refunded remuneration. Quite an interesting deduction, quite an important deduction, because we know the rules around taxation in South Africa. You know, you start, an amount comes into gross income, you're going to be taxed on an amount on the earlier of receipt and accrual, you know, and, as long as it's not capital in nature. But what happens if you earn an amount as remuneration, you get taxed on that amount, and then later on, you end up having to pay some of that amount back to the employer. Now, of course, you know, you can't base tax on logic and say, well, now that I have to pay back, I must therefore get a deduction. But this does allow you a deduction for refunded remuneration. So it's specifically geared towards this idea that you have an amount included in an employee's taxable income, and the employee then has to subsequently pay that back to the employer. For example, it could be something like a sign-on bonus that somebody earns up front, and then they end up having to pay some of that back to the employer. Maybe they leave before their designated period is up, and they have to pay back some of that sign-on bonus, or a restraint of trade payment, or commission, or a bonus. Many kinds of bonuses. We see, somebody pointed out to me the other day, you know, with many of the cases we see happening around corporate failures and so on, and directors having to repay some of their bonuses. So we see some of that happening on quite a broad scale. Now, what happens when this person has to pay this amount back to the employer? Well, the first thing is, when you look at the wording of this provision, it seems to indicate that the deduction only applies if the employee subsequently, in a subsequent year, refunds the amount to the employer. But SARS has indicated that was not the intention. The intention is that this provision should apply even if the employee has to repay the amount in the same year of assessment. And so one of the amendments is to clarify that NA will still apply if you make a refund within the same year of assessment. So if I go to my commission earner and I say he earned commission, let's say, of R1 million in April of a particular year, and then some months later, the employer comes back and says, well, actually, one of the debtors that you sold your goods to has never paid us. They've now absconded. We have to write off that debt. And so you now need to repay some of that commission. And that might be, say, 8 months later, but it's still within the same year of assessment. So this allows the deduction, all right? But now the question is, if it's within the same year of assessment, can the employer take this deduction into account? And that raises an interesting point, and I'll come to that in a moment. But just to clarify that the First Amendment to 11NA clarifies that you can get the deduction if the income is in the same year as the refund. All right, so in my example, the commission earner would have been taxed on that commission when he earned the commission in April. All right, that would have come into his remuneration, subject to employees' tax. It would have come into his gross income. And then let's say the following January, he has to pay back 200,000 Rand of that commission in the same year of assessment. But now let's think about how that payback actually works in terms of the refund and the deduction. Because for the employer to be able to take that refund into account and this deduction into account, it would have to be that it is allowed in terms of paragraph 2.4 of the fourth schedule. And currently it's not listed in paragraph 2.4. Now, paragraph 2.4 of the fourth schedule tells us that the employer has to calculate employees' tax on what we call the balance of remuneration, right? Which is remuneration as defined minus certain deductions that the employer is allowed to take into account. But he can only take into account deductions that are permitted in terms of paragraph 2.4. And currently, the only deductions permitted under paragraph 2.4 are deductions for the retirement fund contributions under section 11F. And there's an aspect of payroll giving that allows in a section 18A deduction up to a certain amount. That is also permitted as a deduction. But apart from that, the employer is not allowed to take into account any other deductions for the purpose of working out employees' tax. And so 11NA is not currently considered. So for my employee, if he got to January and he had to repay that amount back to the employer, well, the employer would, obviously be grateful to have the refund, but would not be able to take that into account for employees' tax purposes. But with this amendment, the employer will be allowed to take it into account going forward from the 1st of March 25 onwards. Okay, so this will provide that any amount referred to in 11NA that is actually refunded to the employer must be taken into account, in other words, deducted in working out the employee's balance of remuneration for purposes of the PAYE calculation. But this will only be from the 1st of March 2025. So currently what would have to happen is that the employee would have to actually claim this deduction on assessment. Okay, so he'd still have the employee's tax withheld, and then when he gets to submit his tax return, he would then claim the amount on and get the refund on assessment. Okay, but going forward, the employer can take it into account. But then, of course, what happens if your amount that you want to deduct exceeds your remuneration for that particular month? In my example, I said this person has to repay 200,000 Rand. Okay, now let's go forward 1 year and let's say this is now April 2025 going through to January 2026. Okay, and when the employer wants to take into account the 200,000 Rand, but maybe the employee's remuneration for the month of January is only 50,000 Rand. Okay, so the employer can deduct the 50,000, take that balance of remuneration down to 0, so that there'd be no employees' tax in January. That leaves you with another 150,000 you haven't yet deducted. Carry that over to February, go through the same procedure again, but let's assume the employee's remuneration for that month is again only 50,000 Rand. So we deduct the 50,000. That leaves us with 100,000 Rand we haven't yet deducted. Now, you can't carry that over to March because that's in the following year of assessment. So the proviso says that if the amount deducted exceeds remuneration, you can carry the excess forward to the next month if the next month is in the same year of assessment. Because, of course, with employees' tax, we have to close everything off at the end of the year of assessment. Okay, so in my example, the employer's taken a deduction of 50,000 in January, 50,000 in February. The remaining 100,000 can't be taken into account by the employer. We've reached the end of the year of assessment. We've run out of available remuneration. And so then the employee would have to go and claim the balance of that deduction through the assessment process, okay, and get the refund from SARS. So quite an interesting amendment that's coming through there, one that is very relevant in the current environment, and it does at least bring some clarity as far as the employers are concerned. Okay, so let's just see if there's anything else. Okay, I think I'm up to speed with all the questions so far. Then let's go on. Before we take our leg stretch, let's just talk about the new investment allowance, section 12V. And this is a new incentive for people who are involved in production of electric and hydrogen-powered vehicles. All right, so corporates involved in that area, in the vehicle industry. And obviously, we have quite a healthy vehicle production industry already in South Africa. But internationally, our international trading partners, there's an ever greater move towards wanting electric vehicles. In fact, some people might say we're a bit late off the starting blocks here. You know, I mean, electric vehicles are like the order of the day when you go over to the US and Europe and the UK and so on. And so obviously there is a need, if we're going to maintain our vehicle industry and keep exporting, we have to produce what the export market wants, even though we don't have a massive uptake of electric vehicles in South Africa, but maybe that will change, who knows. So this incentive is basically 150% tax deduction on qualifying assets, all right? It's targeting new investments in producing electric and hydrogen-powered vehicles in South Africa. And for the purpose of this, they have added two definitions. Battery electric vehicle means any fully electric vehicle powered by rechargeable batteries, and hydrogen-powered vehicle is a vehicle powered by hydrogen fuel cells. Now, the qualifying assets, so we get a deduction of 150% on the cost of qualifying assets. And a qualifying asset is any building, including improvements to an existing building, or new and unused, all right? So brand new and unused machinery, plant, implements, utensils, and articles, together with foundations and supporting structures, you know, subject to the limitation that the structure has a same lifespan as the asset that it is supporting. All right. So on those assets, they must be owned by the taxpayer and used mainly. So more than 50% of the utilization of that asset must be in the production of these battery electric or hydrogen-powered vehicles in the Republic. So this production must be in the Republic. And it's important to note here that the asset must be owned by the taxpayer. It does talk about installment credit agreements, so that is accepted. But bearing in mind that if the taxpayer is erecting a factory on leasehold property, that factory, the building, in terms of our law, attaches to the land, and so that building technically doesn't belong to the taxpayer. All right, so when we say owned by the taxpayer, be careful when you're talking about leasehold property. Yes, we do have section 12 capital N that enables, it deems that if you are in a lease agreement, say with the government or under a public-private partnership, or this IPPP feeding electricity into the grid for Eskom, in those circumstances, you are regarded as being the owner of the property. But that doesn't necessarily apply to factory buildings for purposes of section 12V. All right, so just be careful around owned by the taxpayer, and then, of course, used mainly in the production of these vehicles in the Republic. And the asset must be brought into use on or after 1 March 26. So this is now a year and a bit down the road. But of course, you could start with the whole production process so long. The manufacturing building can be erected, the machinery can be acquired, and so on. But you only get the allowance on assets brought into use on or after 1 March 26 and over the next 10 years, so before 1 March 2036. Okay, so it's a 10-year horizon for this allowance to apply. Now, of course, if you go out then and let's say you invest in a production facility and you spend 100 million rand and you get 150% allowance, so you deduct 150 million rand, that's your tax deduction. And you can create or increase an assessed loss with that deduction. Now, the cost of the asset, 100 million, deduction 150 million, that's brought your tax value of the asset down to zero. If you then go and sell that asset, and let's say you sell the asset for 80 million rand, you're going to have a recoupment of the 80 million rand under Section 84A. So that recoupment will have to come into play. What about the other 50 million rand allowance that we've been able to claim here, the extra 50% over and above the actual cost of the asset? Okay, that other 50% might become subject to a recoupment, and that would be if you dispose of the asset within 5 years, or you change the use of the asset within 5 years, that you're using it mainly for some other purpose other than producing battery, electric, or hydrogen-powered vehicles. So if you then go back to manufacturing diesel vehicles, okay, then you would have to recoup that other 50%. But that's only if you make this change, the disposal or the change of use, within 5 years from the asset being brought into use. Otherwise, you would just do your recoupment under Section 84A. All right, so just bear in mind those special recoupment provisions, obviously also coming into effect for assets brought into use on or after 1 January 2026. Good, and I think that actually brings us exactly on point to have our leg stretch at 3:30. So let's take a 15-minute leg stretch. And if you have any other questions, you can pop them into the chat box. Otherwise, I'll see you back in 15 minutes. Right, hi everybody. We are back from having our tea break. And just to answer the two questions, so yeah, no problem with the transmission, I hope. If your screen is stuck on page 27, that's exactly where you need to be, because we are going to go on in a moment. And then on 11NA, so that was the amendment to the deduction for refunded remuneration. So yeah, these amendments, let me just quickly go back to that slide. So there's the effective date, all right, the amendment to 11NA, years of assessment commencing on or after March 25, and the amendment to the fourth schedule linking to 11NA, effective from 1 March 2025. Okay, because bearing in mind, this is covering your employees' tax calculations, okay? So it's for March 25 payroll and onwards. Okay, so that's the effective date on those amendments, right? And then we've covered the 11B, the 12B allowance. So let's then go on. The next amendment is an amendment to section 21A, which talks about the limitation on set-off of assessed losses. You may recall this limitation rule was introduced for years of assessment commencing on or after 1 April 2022. And it came in when the corporate tax rate was dropped down from 28 down to 27%. And this was one of the offsets to basically say, well, we're having to give up tax by dropping the rate. We are going to compensate with tax base broadening measures, one of which was this assessed loss limitation rule, and the other one was the limitation on interest deductions under Section 23M. Now, this assessed loss limitation rule, so what it does is it limits the set-off of an assessed loss for a company, that an assessed loss that you had at the end of the previous year, you can set off against the current year's taxable income, but limited to the greater of 1 million rand or 80% of the current year's taxable income. But now the problem is that if your company is in liquidation or being deregistered, limiting the set-off of the assessed loss is really just creating an additional tax liability that SARS is then going to have difficulty recovering because of the mere fact that the company is being liquidated, deregistered, or wound up. And on the other hand, it's not that company's never going to utilize its whole assessed loss in any event. So if we take an example, let's say the company has an assessed loss, balance of assessed loss at the end of the previous year of assessment of, let's call it 10 million rand. If in the current year of assessment we have taxable income of 5 million rand before the set-off, we can set off up to the greater of 1 million rand or 80% of current year's taxable income. So 80% of 5 million is 4 million. So you can set off 4 million, and that leaves the other 6 million of the assessed loss that we would carry forward to the following year, right? But what it also does then is you have a 1 million rand taxable income remaining that has to be then taxed at 27%. So that additional tax liability doesn't really make a lot of sense when you've got a company in the process of being liquidated. And so the amendment is to exempt companies in the process of liquidation, deregistration, or winding up from the application of the assessed loss limitation rule. And when we talk about liquidation, winding up, or deregistration, as contemplated in Section 41(4), which we've had that provision in the Act for quite some time. Right, so that amendment will take effect for years of assessment. Now, here's a slightly different effective date than what we've seen. This is for years of assessment ending on or after 31 December 24. Originally, it was going to be 25, but then they realized that, there's no point applying this limitation of assessed loss set-off to companies in liquidation, and so let's just cut it ASAP. And that's basically saying virtually immediately, for years of assessment ending on or after 31 December 2024, you will no longer have this limitation applying to a company in the process of liquidation, registration, or winding up. All right, so that's that amendment. And then this amendment here, it's really just correcting the wording of Section 23D, which is the provision that prohibits the deduction of tax penalties interest. Now, interestingly, you can see here what they're doing is they're adding in the words or interest. So if we looked at this wording without the amendment, it would say that you're prohibited from deducting any tax imposed under this act, the Income Tax Act, or any interest or penalty imposed under any other act, which would be like the VAT Act, Tax Administration Act, etc. But now interest is not imposed under the Tax Administration Act, or to a very small extent it is, all right? Usually interest that the taxpayer is paying is imposed under the VAT Act, perhaps, or indeed under the Income Tax Act, because we still have Section 89 Quat, Section 89 Bis applying, because the interest provisions in the Tax Administration Act have not all become effective just yet. And so they've realized this wording needs to be fixed. So what they're saying is that you can't deduct interest whether it's imposed under the Income Tax Act or the Tax Administration Act or the VAT Act, but it's just clarity in terms of the wording. It's not, I wouldn't suggest that you now go and try and claim in a deduction of interest paid to SARS, because I think we've always understood that interest paid to SARS does not qualify for tax deduction. This is just clarifying the wording in this provision. All right, effective date from promulgation. And then a slightly more complex amendment in Section 24I. Now, Section 24I is a provision that deals with the taxation of exchange gains and losses. So we talk about foreign exchange items. And let's say if you have a loan, a cross-border loan, and that's demarcated in foreign currency, the value of that loan is going to change according to the translation of foreign currency to rand. I mean, if you had a loan, let's say in US dollars, $1 million US loan, end of year one, the rand dollar exchange rate might have been 16 rand to the dollar. End of year two, 18 rand to the dollar. End of year three, 19 rand to the dollar, whatever the case might be. And then it might come back again. So your rand value of that loan is going to fluctuate, and that gives rise to exchange gains and losses. Now, Section 24I provides that the taxpayer is going to be taxed on the exchange gains, all right? And that includes exchange gains on your exchange items as well as premiums, etc. But if you have an exchange loss, it allows the deduction of the loss. And it doesn't specifically talk about trading, non-trading. And what happens is that if you are carrying on, let's say you are carrying on a trade and you have exchange losses, all right, those losses at the end of the year translate and get absorbed into an assessed loss, right, under Section 20. And Section 20, you can then set off your assessed loss against subsequent taxable income, subject to the loss limitation rule we just spoke about. But remember that as a company, if you cease to trade for a full year, then you lose the carry forward of that assessed loss. And that means your exchange losses that might be kind of buried in that assessed loss are buried there. And if you subsequently have exchange gains, even though you're no longer trading, you might still have loans, exchange items that are producing gains and losses. So now your exchange loss is buried in the balance of assessed loss, and yet subsequently you have exchange gains that you're going to be taxed on. And so this interaction, the point they make here, this interaction between the assessed loss set off and the exchange difference rules mean that a foreign exchange loss may be trapped, right? It might not be set off in future years against foreign exchange gains if the company is no longer trading. So what they are going to be doing going forward is if you have a company that ceases to trade, then your exchange losses and gains, there'll be a separate provision that applies to a company that ceases to trade. But the point there is your exchange losses get ring-fenced. They don't get buried into your assessed loss. They get ring-fenced, and you can then set those exchange losses off against subsequent years' exchange gains. So what they're doing with the amendment, Section 24I3, which is the provision that talks about how we deal with exchange gains and losses. And it says, in determining the taxable income of a person affected by Section 24I, we're going to include gains and deduct losses, all right? But now they're going to specifically provide that applies other than to a company that is not carrying on a trade. So a company that is not trading for a year of assessment is no longer subject to 24I3. That company is now subject to the new Section 24I3A. They've got a new provision added in here. And so this will apply specifically to a company that is not carrying on a trade. And this will provide that, yes, your exchange gains are taxed. They must be included in income, but your losses will be ring-fenced. They won't create an assessed loss or increase in assessed loss. They'll be ring-fenced going forward. And that means they'll be available to set off against subsequent exchange gains. All right, so quite an interesting development there. And this comes into effect again for years of assessment commencing on or after 1 January 2025. Then we've got, we're still in the TLAB, and the last amendment in the TLAB relates to an amendment to the VAT Act. And this is an amendment to the definition of resident of the Republic. Now, for VAT purposes, when we look at who is a resident, that definition of resident of the Republic links to the definition of resident in Section 1 of the Income Tax Act. Now, if you have a South African vendor who exports to a non-resident, all right, we generally talk about exports being zero rated. And even with services, if you have a resident that supplies services to a non-resident who is outside the Republic at the time the services are provided, that supply of services from your resident vendor to the non-resident would be zero rated under Section 11(2)(L). But a problem has now been brought to light where you might have group companies, and let's say you've got a holding company in South Africa, a resident, and that has foreign subsidiaries outside South Africa, okay? Now, if the holding company provides services, so maybe they provide management fees and they invoice the subsidiaries for those management fees. So it would seem like an exported service. It would seem that we are providing a service to a non-resident, to the foreign subsidiary. But is that foreign subsidiary a non-resident or is it a resident? You see, the definition of resident in Section 1 of the VAT Act, as I say, then looks to the definition in the Income Tax Act. And for companies, a person is a resident if it is incorporated or formed in the Republic, or paragraph B, if it is effectively managed in the Republic, if it has its place of effective management in the Republic. Of course, we have the overall exclusion that applies to everybody, that the definition of resident excludes any person who is deemed to be exclusively a resident of another country under a double tax agreement. But in my example, if we have the South African holding company that is the resident, has the foreign subsidiaries, if those foreign subsidiaries are managed by the same board as the holding company, then they would be regarded as being effectively managed in the Republic. And barring this exclusion for the DTA, let's assume there is no DTA, that they're not deemed to be exclusively a resident in the other country under the DTA, then what happens is that those foreign subsidiaries are actually residents in terms of the definition. Even though they don't carry on business in South Africa, they have no enterprise here. They're incorporated outside SA and they carry on business outside SA. But because of the place of effective management, they come into this definition of resident. Then that means that that management fee that the holding company is charging the subsidiary would have to carry VAT. It will not qualify for the zero rating because it's not a supply to a non-resident. It's regarded as a supply to another resident of the Republic. And so that VAT that is then charged to the subsidiary, what would the subsidiary do with that VAT? The subsidiary has no enterprise, it has no suppliers in South Africa, it is not a vendor. And so it can't claim that VAT back as an input tax credit. So the VAT becomes a one-sided transaction, an extra layer of cost. And that's an unintended consequence here. So they're now going to amend this definition of resident of the Republic in Section 1 of the VAT Act to exclude anyone who is a resident solely because they have their place of effective management in the Republic, as long as they do not actually carry on an enterprise in the Republic. All right, so these foreign subsidiaries who don't carry on business in South Africa, they just have the same management as a holding company, they would now be excluded from this definition of resident of the Republic. They then remain non-residents, and then the zero rating provision can apply. But notice here, this only comes into operation from the 1st of January 2025. Okay, so this is going to be a problem still all the way through until that date, and then this amendment will take effect. Right, and so that's really on the side of the VAT Act. Then we get on to, just jumped a slide there, we get on to amendments under the TALAB, the Tax Administration Laws Amendment Act. And the first few amendments are to the VAT Act, so we stay on this theme of VAT, all right? And then we go on to amendments to the actual Tax Administration Act. So these first few amendments, again, dealing with cross-border. So there's obviously been a big focus on multinational corporations, cross-border transactions as far as SARS is concerned. And I think many of these concerns have been raised for many years, and they are finally finding that there's somebody listening, and some of these amendments are now coming through. The first one here, the VAT on imported services. So VAT has to be paid on imported services. Any person who is receiving imported services in South Africa has to pay output VAT. But when we talk about imported services, that is defined as a service from a non-resident to a resident, but only to the extent that the services are used other than for making taxable supplies. All right, so if a non-vendor was using imported services, you'd have to pay VAT on that. And if a vendor was using imported services, perhaps using an international consultant, if the vendor has both taxable and exempt supplies, they would have to raise output tax to the extent to which those consulting services are used for the exempt supplies, so other than for taxable supplies. So this is where VAT becomes payable. And then in terms of Section 14, the VAT has to be paid within 30 days of the time of supply, the earlier of receipt of the invoice from the supplier or the time any payment is made in respect of the supply. So you've got 30 days to pay the VAT, and that's a very tight time frame. And if the VAT has to be paid late, then there's going to be a 10% late payment penalty that is applied. And so the practicalities of that have now been heard, and they've now pushed out the payment time. So you have to settle the VAT to SARS now within 60 days of the earlier of invoice or payment. All right, so this also effective from the date of promulgation. Just to mention, now that we're talking about all the administrative amendments, the general effective date is the date of promulgation of the Act, unless stated otherwise. Now, there are some amendments where we will see other effective dates, but generally it's the date of promulgation. Then we talk about overpayments of VAT on the imports of goods and services. Again, in terms of Section 7.1b, importation of goods, any person who imports goods has to pay VAT. 7.1c, any importation of services gives rise to output VAT. But now the issue is, what if the tax is overpaid? There is provision in the Tax Administration Act for refunds of amounts that have been erroneously paid, but that doesn't adequately cater for this situation where you are overpaying VAT on the importation of goods or services. And so this amendment introduces two specific targets. The one is Section 16.3p, which applies for vendors, right? It's an input tax. 16.3 talks about a vendor claiming a deduction against output tax. So on your VAT return, you're claiming an input tax. And subsection P applies where there's been an overpayment of VAT charged under Section 7.1c, which is on your imported services. All right, so there, if you've overpaid the VAT, you claim it back as an input tax on your next VAT return, and off you go. But if you're not a vendor and you've now paid VAT on importations, and it turns out that you then have overpaid, then you can get the overpayment back from SARS, but you have to apply to SARS, and you've got to do the application within 5 years from the date on which the excess payment was made. Okay, effective on date of promulgation once again. And then still in the area, looking at multinational corporations and non-resident suppliers of goods and services into South Africa, it's finally been realized that many of the administrative provisions around non-resident vendors are just far too onerous. And if we look at our definition of enterprise in South Africa, the supply of goods and services in South Africa for consideration. So, I mean, that can be a once-off supply, an ongoing supply. It's a very wide definition. And it talks about making the supply. We have a place of supply rule in South Africa. If you're making the supply in South Africa, you carry on an enterprise in South Africa. And that brings non-residents into the VAT net, that they have to then register as vendors. And being registered as vendors, they have to have a representative vendor who's in South Africa, and they have to have a South African bank account. And this becomes quite onerous, especially if they don't have any physical presence in South Africa or only a very limited presence for a short period of time. So they did, a couple of years ago, relax the requirement for the South African bank account as far as your suppliers of imported electronic services were concerned. And now they are extending that to other non-resident vendors as well. They've also realized, looking at imported electronic services, that that scope is too broad, that they need to exclude business-to-business suppliers. If you think about imported services, remember the definition there, only to the extent the services are used other than for making taxable supplies. So there we've excluded business-to-business suppliers. But for imported electronic services, we did not have that exclusion, and now they're saying that they need to build that in as well. So the amendments coming through here, a number of them, sorry, I've truncated that a bit, but they basically are cutting out the requirement for a non-resident vendor to have a South African representative. Okay, so that will no longer apply from the date of promulgation. And then as far as the South African bank account is concerned, if you're an external company that doesn't actually carry on an enterprise in South Africa, or if you're an individual who doesn't spend more than 6 out of any 12 months here, or if you're a supplier of imported electronic services, you would not have to have the South African bank account. Okay, so they have relaxed those rules as far as the non-resident vendors are concerned. So those are the administrative amendments to the VAT Act. Then we talked to the amendments in the Tax Administration Act, all right? And there's a few amendments coming through here. The one linking to the Poulter decision, we spoke about the Poulter case earlier this year. It was a judgment handed down by the Western Cape High Court in April 2024. And it looked at the question of whether a lay person could represent a taxpayer in the tax court. And the court concluded that, yes, indeed, a taxpayer may be represented. Now, some of you who've been around a long time might wonder why this became such an issue, because has it not always been the case that a taxpayer could be represented by a layperson in the tax court? In the judgment, it became clear that we did used to have a provision in section 125(2) that made it quite clear. And then for some strange reason that's not quite clear, that provision was deleted in 2017. And yet the court said in the judgment that that amendment to the legislation didn't necessarily change the situation, because they went into this whole long evaluation of what is the status of a tax court. Does it have the same status as the High Court, the SCA? In terms of the Constitution, they came to the conclusion that the tax court is actually more of an administrative tribunal. It's not in the same status as a High Court or the SCA. Therefore, whereas you have to have a registered legal representative in one of the actual courts, but for the tax court, that requirement did not apply. So in terms of the Poulter decision, they said that we've always had the situation that a lay person can represent a taxpayer. But just to make it 100% clear, they've now put section 125(2) back into the Tax Administration Act, but slightly longer, slightly different wording to what they had before. So it now is going to say the appellant, and that of course is the taxpayer. Remember, it's the taxpayer that's taking the matter on appeal, and they've ended up in the tax court. All right, so the appellant here, we're talking about the taxpayer, or the representative of the appellant may appear at the hearing of an appeal in support of the appeal, provided that if the representative of the appellant is a person who is not a legal practitioner, the president of the tax court must be satisfied that the person is fit and proper to appear on the appellant's behalf. So what they've added in here is they're giving the president of the tax court the last word on the matter. So the president can actually say, no, your representative is not a fit and proper person. But I mean, when they say fit and proper person, they're not using the same criteria as we use when we're evaluating legal practitioners. So this is a term that applies in the Legal Practice Act. And obviously that would talk to within their own profession. Whereas now you could be in the tax court and you might have an accountant, or not even an accountant, just a lay person without any professional qualifications representing you. That person might well be quite capable of representing you, even though they're not registered as a legal practitioner. But the president of the High Court does have the last say, and that's really what's coming through here. Now, notice here this effective date. This amendment will come into effect on a date to be determined by the minister by notice in the Gazette. And that's because this is part of the dispute resolution process, right? The rules of the tax court sit within Chapter 9 of the Tax Administration Act, which deals with the whole dispute resolution process. And we'll see that there are other amendments coming through linked to the dispute resolution process. And with all of these amendments, it's going to require changes to the rules that are promulgated under Section 103. And then those rules have to be put out, the proposed amendments, the rules have to be put out for comment, and then finally the actual changes will be gazetted, and then these amendments will come into effect. So it'll take a couple of months or a few months, but from the Poulter decision, we know already that a taxpayer can be represented by a lay person. This is just clarifying the wording in the legislation. Okay. Let's go on to Section 47, and this is one that probably strikes fear into the heart of many people, the idea of being called for an interview at SARS, all right? It's part of the collection of relevant material. Well, the actual obtaining relevant material and the rules around that are in Section 46, and this sits in Section 47, and provides that a senior SARS official may notify a person to attend an interview in person at the time and place designated for the purpose of being interviewed by a SARS official concerning the tax affairs of the person. But notice that this can only happen if the interview, A, is intended to clarify issues of concern to SARS, to render further verification or audit unnecessary, or to expedite a current verification or audit, and is not for the purposes of criminal investigation. All right. So that's how it stands at present. Now, all that's changing here is that they're adding in a third paragraph, A3. And A3 is going to read, in other words, the interview is intended to clarify issues of concern to SARS for an application for an installment payment agreement, write-off or compromise of tax debt. So it's to expedite this process. And so this is considering that a taxpayer who applies for payment arrangements with SARS or applies to have a debt written off or compromised, they could be called to an interview. Okay, so that's the amendment and from the date of promulgation. Then last year, and you might remember in last year's update, we spoke about the Arena Holdings case that went all the way through to the Constitutional Court, looking at the question of access to taxpayer records. And the Constitutional Court held that the absolute prohibition on accessing any person's tax records was actually unconstitutional. And this came through the Promotion of Access to Information Act, and the TAA links into that act. And the Constitutional Court, in their judgment, ordered that the wording of these provisions needs to change. But in the meantime, they gave in a read-in provision. They said, this is how it must read. Now, all that's happening here is that we are seeing that wording being incorporated into the legislation. So there'll be separate amendments to the Promotion of Access to Information Act, the PIA. Obviously, that doesn't fall under the remit of National Treasury, so it's not in any of the bills you're looking at here. But that amendment will come through, and it will say that in extreme circumstances where it's in the public interest, that access can be granted. And then if access is granted under that provision, then it could be allowed in terms of Section 67 and 69 of the Tax Administration Act. Those provisions are being amended to follow what is happening in the Promotion of Access to Information Act. And the Customs and Excise Act will be amended accordingly. So there you can see these amendments coming through. We don't really need to go through that. This amendment will be from the date of promulgation. And then auto-assessments. Now, auto-assessments have been with us since 2020, and I think we've all got fairly used to how auto-assessments work, all right? Or there's always anomalies, but generally speaking, I think it does expedite the assessment process to some extent by SARS actually assessing a taxpayer based on the third-party information that they receive. But remember that the responsibility is still on the taxpayer to check that whatever comes through on the auto-assessment is correct, and the taxpayer will be held liable for that they must check that it's correct. And if it's incorrect or incomplete in any way, then the taxpayer is required to submit a tax return to SARS so that a correct assessment can be issued. But now this amendment really hinges around what is the legislative framework, because as much as, you know, we might think auto-assessments are a good idea, but SARS cannot implement any of these administrative changes unless it is permitted in terms of the legislation, and especially in terms of the Tax Administration Act. And SARS had originally put these auto-assessments into Section 95 of the Tax Administration Act, which speaks to estimated assessments. And so they treated this as initially an estimated assessment, which would become final, you know, if the taxpayer didn't submit a return, or if the taxpayer did submit a return, then a proper final assessment would be raised. But there was a lot of argument as to whether Section 95 was the correct place to allow for auto-assessments, because certainly there was an argument from SAICA, a very strong argument, to say that Section 95 was always intended as a punitive provision, and it's intended to apply where a taxpayer fails to submit a return, then SARS will raise an estimated assessment. And so it's the wrong place for the provisions around auto-assessments. And finally, it seems SARS has now accepted that argument, and they've said they'll make this amendment to rather amend Section 91 to allow for auto-assessments. And there's some changes coming through there. It's not really going to change your life in any way. It's just, where do auto-assessments fit within the legislative framework? Then in terms of the dispute resolution proceedings, again, we go back to these provisions in Chapter 9, Section 104, 107, and Section 109 of the Tax Administration Act. Now, the first amendment around Section 104 is really just shuffling the wording around to take the same format as what we have in Section 107, but the actual rules are not changing. It's just that the sequence of wording in Section 104 is changing. It's still going to provide that SARS can condone the late submission of an objection up to 30 days if there's reasonable grounds, beyond 30 days if there's exceptional circumstances, etc., but never beyond 3 years. So those rules are still there. That doesn't change, okay? It's just the way in which it's worded will change. And so they're amending Section 104.4 and 104.5 to kind of follow what's in Section 107. But then what is changing that will affect you is that they are going to be introducing the ADR, the Alternative Dispute Resolution Process, at the objection phase. So currently, if you object to an assessment and if SARS disallows part or all of your objection, you then go on to appeal, right? And in that appeal process, it may be that you agree to make use of the ADR. Now, that ADR process, SARS wants to introduce at the objection phase, so that when you object, and you'll see the wording in a moment, I think I've still kept that on the slide. We'll show it to you now. By mutual agreement, the taxpayer and SARS can agree to make use of the ADR. Now, the reason why SARS has decided to introduce this at the objection phase is as a means to try and clear this backlog of disputes. There's a huge backlog of disputes at SARS, a logjam, and they need to clear it somehow. And so they feel that this might expedite the process and get things moving a bit quicker if some of these disputes can be resolved making use of the ADR. So at the point that you apply or that you submit your objection, what will happen, and this is what's coming through Section 104, subsection 6 and 7, by mutual agreement, SARS and the taxpayer making the objection may attempt to resolve the dispute through ADR under the procedure specified in the rules. Now here, of course, the rules currently don't allow for this. So we have to have an amendment to the rules to deal with ADR at the objection phase. And once those amendments come through, then this amendment to the legislation will take effect. All right. So you'll see that the effective date is a date to be determined by notice in the Gazette. So once this becomes effective, when you lodge your objection and SARS considers that now it is suitable for ADR, but they can't force you into ADR. It has to be by mutual agreement. SARS and the taxpayer attempt to resolve through ADR. All right. And if you do elect to make use of the ADR, then proceedings on the objection will be suspended while the ADR is ongoing. So the ADR would take place, a decision would be made. If the taxpayer is still unhappy with that decision, then they would go on appeal and they would carry on through the process there. Maybe there'd be another ADR. We'll have to see what happens in terms of the rules. But it certainly brings that possibility of ADR earlier in the process. Now, not all commentators were completely on board with supporting this amendment. Certainly, SAICA was very outspoken against it, and they made it very clear they do not support this because the concern was that SARS might utilize this to sidestep the very strict timeframes and procedural rules that exist for the objection process. Whereas when you go on to ADR, it becomes a little bit more free-floating, as it were. So it remains to be seen. SARS' response was that SAICA's concerns were misguided or unfounded, and they felt that ADR was appropriate and was working very well. And so they've gone ahead with this amendment. All right. So whether you like it or you don't like it, it is still going to go ahead and it's going to happen. But notice, not immediately. All right. It'll be from a date to be determined in the Government Gazette. So it's probably going to be about another 4 or 6 months down the line before this actually does happen. Also, to deal with disputes, and now disputes that have gone on to appeal, Section 107 is going to allow the taxpayer to approach the tax court for an extension of up to 120 business days for the lodgement of their notice of appeal, if the extension is in the interests of justice. That would be where the senior SARS official refuses to grant an extension or maybe is no longer empowered to do so because you've gone past the normal extension period within Section 107. This is then allowing an application to the High Court to go up to another 120 business days. Okay, so just to provide for that condonation period. And so that's the amendment of the wording. We don't need to look at that. Section 109 is being amended in terms of encouraging people to make use of the tax board. All right. I think many people just go kind of straight from appeal to the tax court. And SARS, again, is referring to the fact that they've got this big backlog of disputes that need to be resolved. And the tax board seems to be underutilized. Now, remember that you can take matters to the tax board if the dispute involves amounts not exceeding R1 million and not unduly complex. And what they're doing is they're amending this provision to really make the tax board the first port of call if you fall within that financial limit. So it's going to read, an appeal against an assessment or decision must, in the first instance, be heard by a tax board if the amount does not exceed that R1 million, unless a senior SARS official and the appellant, the taxpayer, agree that the matter be heard by the tax court. All right. So if there's mutual agreement to go to the tax court, you could make that option. But otherwise, your first port of call will be the tax board to try and get matters resolved there. And that's also going to be the date of promulgation. Okay, and then an interesting amendment, especially for companies that might be in business rescue, or if you're a business rescue practitioner, this is something that you need to pay attention to. So currently, Section 195 allows a senior SARS official to temporarily write off tax debt. On the one hand, that could be if the debt is uneconomical to pursue, or if the company is in business rescue. Now, what they're going to be doing is deleting paragraph B. So you're not going to get this immediate and kind of fast route access to this temporary write-off if you're in business rescue. That will no longer apply. So paragraph B is going to be deleted from the date of promulgation. So it will leave you with having to make use of this aspect of being uneconomical to pursue. And that is, as described in section 196, basically means the total cost of recovering the tax debt for SARS will likely exceed the anticipated recovery, and they factor some criteria into that. How long has the debt been outstanding? What will be the cost of recovery, et cetera, et cetera. And they would then evaluate whether it's uneconomical to pursue. So they say they don't need to have this kind of fast shoot for business rescue, because they've got their data, analytics, and so on that they can use to establish whether a debt is uneconomical to pursue. So they'll just keep that part of this provision. And then there's some rules that are being tightened up around appointing a public officer. We saw last year quite a lot of amendments coming through in this space, especially as a result of South Africa being grey listed and our regulation environment, of course, ramping up quite significantly. And here's just kind of tail end of these amendments. So the one is that when a company is actually incorporated, registered at SIPC, it is automatically registered for income tax, all right? And so they're saying at the point of registration, you must have your directors and public officer in place. There's no longer going to be a 1 month period in which you can appoint a public officer. And if you fail to appoint a public officer at the time of formation, then, well, you won't have the 1 month grace period. So you then would go into section 247, which provides for a default rule determining who is going to be the public officer. SARS will determine that based on a hierarchy. So in section 246.2, they are simply deleting subparagraph D, which allowed a 1 month period for appointment of the public officer. And just remember that the representative who's going to be the public officer has to be a suitable person, must be a South African resident, etc., and must not be prohibited from being a public officer in terms of being, for example, a delinquent director or something of that nature. So the hierarchy, if no public officer is appointed, then section 246.3 has been amended to provide a much more detailed hierarchy than what was there before, to say SARS will have reference to this hierarchy to decide who is the most senior person in the company, and that will be the person who is going to be deemed to be the public officer, and that will be the person that SARS designates as being the public officer. So going managing director, etc., all the way down the hierarchy to establish the most senior person would be the one that SARS would identify as being the public officer. All right. And then we've also got this consequential amendment. A company is regarded as not having appointed a public officer if the person appointed is not eligible. And we spoke last year about these amendments to these provisions around eligibility or non-eligibility. So people who are delinquent directors, for argument's sake, have criminal records and so on, they would not be eligible to be the public officer. All right. And if you do not have a proper public officer, you've got 21 business days to appoint. Otherwise, again, SARS is going to appoint somebody based on the hierarchy that I just showed you. And this also effective from the date of promulgation. Okay, so that brings us to the end of the Tax Administration Laws Amendment Bill and the administrative amendments. What we have on the slide here is a list of all of the sort of main tax case judgments, and they've got live links to the actual judgments that you can have a look at should you so wish. Most of these we have discussed during the course of the year as we've done our updates over the year. I'm just going to pick up on some of the more recent ones, like this Thistle Trust judgment, which is a constitutional court judgment handed down in October, and certainly has caused quite a lot of dispute and discussion amongst our tax experts and especially the legal fraternity around the decision in the Thistle Trust. Now, this was an appeal that the trust took to the Constitutional Court after the SCA found in favor of SARS. So there was a tax court decision in favor of the taxpayer, the trust. SARS took that on appeal to the SCA that found in favor of SARS, and then the taxpayer took the matter onto the Constitutional Court. And it all revolves around capital gains, basically, and looks at the conduit principle, Section 25B, and I should mention paragraph 82 of the 8th schedule. And it's really looking at whether the conduit principle, which has now been legislated in Section 25B, whether at the time that the facts of this case happened, which was 2014 to 2016, based on the wording of the legislation at that time, could it be argued that Section 25B would also apply to capital gains? All right. Now, it was not a clear decision. Chaskelson wrote the majority judgment, and Bilchitz had a dissenting judgment, and one of the other judges sided with him. Everybody else went with Chaskelson. And so we had a majority judgment that actually found in favor of SARS and found against the taxpayer. SARS had also brought a cross appeal dealing with understatement penalties on the basis of bona fide inadvertent error, but the Constitutional Court did not allow that cross appeal to proceed. And it all revolved around this kind of tiered structure. So we had a tier 1 group of trusts, 10 vesting trusts. They were property owners and developers, and so they would sell properties from time to time and have capital gains on the sale of those properties. Now, the facts of the case dealt with the 2014, 15, and 16 years of assessment. All right, so it was capital gains that arose during those years. These were vesting trusts. And so the capital gains that arose vested in the beneficiary, which was the Thistle Trust, our taxpayer, okay, or the appellant in this case. And the Thistle Trust is a discretionary trust, an inter vivos discretionary trust that has certain beneficiaries. So in each of those years, when the capital gain arose from the disposal in the tier 1 trust, vested in the Thistle Trust, and then the trustees exercised their discretion and distributed those capital gains to the beneficiaries. And the question was, where is the capital gain taxed? In the trust or in the beneficiaries? If the capital gain was distributed in the same year that it vested from the tier 1 trust. Now, currently, in terms of the wording of Section 25B and paragraph 82, 25B applies to income other than capital, right? So it's very clear that 25B doesn't cater for capital gains. But that was an amendment that was made fairly recently. And so at the time of 2014 to 2016, that amendment had not been made. So the question was whether Section 25B could apply to capital gains as well. You see, if you look at paragraph 82 of the 8th schedule, that talks about a capital gain arising in a trust, which would be this tier 1 trust, and then vesting, and it would then allow the capital gain to be taxed not in the first trust, but in the second trust, because it vests in that trust. But now the capital gain has not arisen in this trust. And so the argument is, and the wording of paragraph 82 has now been amended to clarify that it doesn't apply to the subsequent distribution down to the beneficiaries. But if Section 25B applied, it would enable the conduit principle to flow all the way down, layer after layer after layer. And so it's important to note that paragraph 80 has this plug at this point here, that you can't have capital gains flowing through from tier to tier to tier. Whereas Section 25B, of course, with income does allow that. Now, yes, 25B has been amended recently to only apply to resident beneficiaries, okay? And paragraph 80 is always applied only to resident beneficiaries. But it's interesting that 25B allows the ongoing flow through, whereas paragraph 80 talks about a capital gain arising in one trust from the disposal and then vesting. That's as far as that flow through can go. And then it ends up being taxed there. All right, so the Constitutional Court basically was looking at how this conduit principle applies to the taxation of capital gains. And they said we have to look at the actual conduit principle and the interpretation of sections 25B, 26A, which talks about the taxable capital gain being included in taxable income, and then paragraph 82 of the 8th schedule. And as I say, at the end of the day, they dismissed the appeal of the Thistle Trust and they found in favor of SARS. All right, as I've just explained. And it's quite interesting in terms of the dissenting judgment. I should just mention the dissenting judgment from Bilchitz. His point was that paragraph 82, as it was worded at that time, was not clear and it didn't give a clear explanation. In fact, even the Constitutional Court, in order to work out what it was actually trying to say, they went back and looked at the explanatory memorandum, which is actually quite inappropriate because the explanatory memorandum does not form part of the legislation. And legally, that the legislature provision must stand on its own, and you must be able to interpret the meaning and the application of that provision from the wording of the legislation itself. And that was where Bilchitz was extremely critical and said, the wording is not clear. And because the wording is not clear and there's uncertainty, the contra fiscum principle should be applied. And that means you should be finding in favor of the taxpayer. So that was the minority finding of the Constitutional Court, but the majority held in favor of SARS, and they dismissed the taxpayer's appeal. So quite an interesting outcome there. And yeah, we don't really have time to go on to any of the other judgments because I want to also just give a bit of time to answer any questions. All right. So in terms of this question around the audit, yeah, 21 business days to respond. That's to respond for a request for information, right? Any section where you can get an extension? No, not specifically. There isn't a provision there unless you can ask. So, you know, if you went into the courts and you ask the courts to give extension in terms of fair administrative process, but otherwise, no, there's no specific provision for that. And then is there an easier way than the online service system to register a taxpayer, register a representative for SARS? It looks as if SARS is taking the full 21 business days to complete the registration. And are you talking about registering for income tax? Well, whatever it might be, unfortunately, it is the online system that one has to use to register and to register the representative, right? The representative for SARS, yeah. As far as I know, there's no other system that can be used. So you have to use that, unfortunately. So the point is, if they're not dealing with it, then you would need to, of course, go the complaint resolution process and try and get the matter resolved that way. But yeah, unfortunately, no other official process to use. All right. So yeah, that brings me to the end of the questions. If there's anything else, you're welcome to raise questions. We can give a couple of minutes while we finish off, but otherwise for me just to say to those of you who are not asking questions, just to say thank you so much for joining us this afternoon. And I hope it has been a very useful session for you and to wish you all the best for the rest of 2024 and beyond. Let's have a look at this question from Peter. I found SARS audit open to giving a reasonable extension. If you just go back to them and ask them for that, thank you. That's useful guidance for people in that situation. All right, otherwise that's it from my side. I'll hand back to you, Stan, and just to say thank you very much for the opportunity to present today, and I hope it has been a useful session for you. Cheers, everybody. Bye-bye.
Thank you, Jackie. Just before you go, I've got a tongue-in-cheek question, or partly tongue-in-cheek. Could AI reorganize this whole tax administration act? Just put it into AI and they'll sort it out for us.
In terms of the wording, well, no, I don't know. I mean, you know, yeah. Well, AI is useful for many things, but of course, you've got to be sure that your intention is coming through because the AI is a machine that doesn't know your intention. So you would have to still have a look at the end of the day to say, is the wording here reflecting the intention that is behind the provision? Yeah, so AI can be useful, but I don't think we could step back and let it do the job all by itself.
Just ask to refine the Tax Administration Act.
Yeah, well, there's some other parts of the act I wouldn't mind rewriting as well. But yeah, so it has its uses, but we can't step back and just hand over, unfortunately. Well, fortunately, we still need humans to do a lot of the work for us, yeah.
Okay, so before I thank you for today, and thank you everybody for attending, just a note, there are no more webinars this year. We will be putting a full program in for 2025, but in the interim, we'll be sending out a notice with for catch up. So all of the webinars that we had this year, if you need to catch up, we can supply the recordings and you can catch up and give you the certificates accordingly. To echo your words, Jackie, just to wish everybody well over the year and a if you're going away, come back safely, and we'll see you in the new year. And Jackie, thanks as always for an interesting afternoon. Thanks, Danny. I don't know if there's anything you wanted to add to
nothing
that.
from us. Nothing from us. Not feeling great. This is weather changing. But everyone keep well and have a good year.
Yes, and to the rest of the year, and enjoy, and thank you, everybody, and good afternoon. We finished a little early, so I can knock off early, and
Good.
thanks a lot.
Okay, thanks.
Your certificates will be on the way. Cheers.
Thanks, everyone. Goodbye.
Cheers.
Bye.